This simulation tracks the mechanics of a common market trap. The price spikes through a major threshold, hesitates, and immediately collapses in the opposite direction. For most traders, this follows a predictable psychological sequence. It starts with the fear of missing out as the price rockets upward, leading to an impulse buy at the very top. Then a moment of confusion as the movement stalls, followed by a sudden exit as the position is wiped out. This cycle repeats because many traders prioritize entry signals and indicators over foundational chart literacy. They apply high-level theoretical strategies to a live market without first understanding the mechanical conflict that determines if those strategies have room to work. The problem often begins with a reliance on color. We are conditioned to see a green candle and assume the market is bullish, or see a red candle and sense immediate danger. This treats the chart like a simple indicator, rather than a record of two sides fighting for territory. When you trade without reading the underlying structure, you ignore the environment where your strategy lives. In this state, even the most complex trading system behaves like a coin flip because the execution is disconnected from the actual flow of capital. To understand that flow, we have to look at the individual candlestick. By stripping away the red and green, we can see the shape for what it actually is, a report on who attacked, who defended, and who ran out of ammunition within a specific window of time. The central rectangle is the body. A long, solid body indicates that one side dominated the price action from the opening bell to the close, meeting virtually no resistance from the opposition. The vertical lines on either end are the wicks, and these record failed attacks. A long upper wick tells us that buyers pushed the price up, but sellers absorbed that pressure and drove the price right back to where the period started. We can add more context by looking at the volume bar graph at the bottom. While the price shows you who won the skirmish, volume reveals the amount of capital, the actual effort, expended to move the needle. This leads to the principle of effort versus result. If you see high volume paired with a very small candlestick body, it means massive effort was put in, but the price didn't move. One side is eating every order the other side throws at them, which is often the first sign of a reversal. Mastering these micromechanics provides an objective warning system. It allows you to identify market exhaustion before the trend actually turns. When we zoom out, these individual battles form a broader cycle. Every market is constantly moving through four distinct structural states. An active trend functions like a successful military expansion. In an uptrend, the buyers push to a higher high and then successfully defend their new territory, creating a higher low. This expansion is confirmed by a break of structure, or BOS. This happens when a candle body closes beyond the previous swing point, proving that the trend has the momentum to maintain its new territory. The trend fails when the momentum shifts. The attacking side fails to reach a new peak, and the price subsequently crashes through the previous defensive wall, the last higher low. This collapse is a change of character, or chach. It marks the moment power shifts from one side to the other. However, a structural shift on a lower time frame is often just noise. For a chach to be significant, it needs to align with the dominant trend on a higher time frame, like the 1-hour or 4-hour chart. Tracking these markers allows a trader to see who is actually in control. It replaces the need to guess the trend with a mechanical way to verify it. Returning to the failed trade from our opening scene, we can now map the specific mechanics that drove that collapse. Look at this resistance line. Because it has been tested multiple times, it attracts a dense cluster of stop-loss orders from traders who are shorting the market or waiting for a breakout. Institutional players often push the price through these boundaries specifically to trigger those orders. When those stop-losses are hit, they create a sudden wave of buy orders. Institutions use this surge of retail buying as the necessary liquidity to fill their own massive sell positions at a favorable price. Once the liquidity is absorbed, the price plummets. The defense against this is simple. Wait for the candle to close. A wick that pokes through a level and pulls back is a liquidity sweep. A body that closes beyond the level is a confirmed breakout. Requiring structural validation is the only way to ensure you are trading a real shift in power, rather than acting as the fuel for institutional orders. This figure stepping away from the crowd